Welcome, everybody. My name is Ed Cohen. I'm one of the leaders of Partners for Democracy, and we're delighted that you're here. For those of you that know our group, you'll note that the special events is a bit of a deviation from what we normally do. We exist primarily to help our network make smart investments with their campaign dollars. We recommend grassroots groups and candidates to in key races so that when you're making a contribution, you know who needs the money and who does not. But this is a different kind of event for us. This is not an electorally focused event. And we're doing it because Congress has accelerated its consideration of up to three crypto bills. And this legislation will define the future of uh, cryptocurrency, something which for many of us is a mystery. So we figured a tutorial might be helpful for us to understand what we're about to have handed to us. And as we'll learn, it's fraught with risk, and the legislative framework is likely to be inadequate. Before proceeding, let me make two quick points. One is that because of the complexity of what we're going to talk about and how much time it's going to take, we're going to skip the Q&A session so we have the maximum amount of time for presentation from our experts. And the second is that this is being recorded, and we will put the recording up on our website, and I will put the link to our website up on the chat. Bert Four, who's one of our leaders, has put together a remarkable group of speakers, which I'm about to introduce. But we gave those speakers an impossible task. We asked them to explain how crypto works and what its risks are, but to do it in terms that are understandable. And if that wasn't bad enough, we asked them to stick to an allotted time. So I thank them in advance for that. Uh, Let me begin now by introducing our keynote speaker, Simon Johnson, who is the 2024 Nobel Prize winner in economic scientists. He currently teaches entrepreneurship at the MIT Sloan School of Management. And I'm sure I could go on forever about his resume, but I won't. And I'll turn this over to you, Simon, and thank you for joining us.
Thank you very much, Ed and Bert and everyone for this organizing this terrific event and for this opportunity to discuss such an important topic. My role this evening is quite straightforward. I'm going to speak for no more than 10 minutes and just emphasize the importance of the issues that we're discussing, all of the specific issues around the legislation, which our friends are going to come to in a moment, and also the bigger questions around what is cryptocurrency and why does it matter. I should also like to say that you've got three of the best experts in the world in Corey, Art, and Amanda, who are all going to dive into specific key details that really matter this week. So I hope you pay attention. I hope you take some notes. I hope you follow up with each of them. They've got terrific materials on their various websites and in their various writings. So please keep in mind that this is just to get you into the water and get you familiar with some of the key issues, and hopefully you'll dig further, because I think nothing is more important in this democracy than understanding what is being decided for you and supposedly on your behalf. And when it comes to crypto, the issues are really essential to the functioning of this economy, to how we create jobs, to who gets a decent income, to whether or not we have prosperity. Because what crypto is attempting to address and change, actually in some potentially quite fundamental way, is two things. First is money. And as you know, money runs the world. Money certainly runs the American economy. So what is money? How does money operate? Who has access to money and on what terms? And very closely related to that, although we don't always think of these things as close, but believe me, they are very close, is how do we make our investments? Do we understand the products being offered to us? Are the people who are selling these products, these investment products, are they being honest? Do they have a legal obligation to be honest? Do we have full transparency into the financial products that are being offered to us? Now, these are obviously fraught questions at the best of times. We've had many problems in the US economy. In living memory, we've had some major problems. And what worries me specifically is at the end of the 1990s, and actually signed into legislation in the year 2000, was a bill known as the Commodity Futures Modernization Act. And there were some very prominent and important people who warned about that legislation at the time. My good friend Brooksley Bourne is, I think, the most famous and was the most outspoken. And unfortunately, her warnings were not heeded. And what we got was legislation that dealt with part of the financial markets. It seemed, I think, to some people rather esoteric, maybe even somewhat minor. It was over-the-counter derivatives and how they should be traded. But that turned out to be a really important piece of what happened in the early 2000s, and it played a major contributing role in the financial crisis that hit us all in 2008. So you can go from legislation around what might seem like technical financial market details to a really big macroeconomic problem in under a decade, or at least we did that recently. So we could absolutely, if we're not careful, find ourselves on a path along which crypto plays some sort of accelerant role, or maybe it becomes the driver of the next financial crisis if we're not careful. Now, I'm not opposed to innovation. I don't think my colleagues here are opposed to innovation. Innovation is a very important part of the American economy, and it's an important part of what we always imagine could be and should be a better future for ourselves, for our children and our grandchildren. But when it comes to finance, you've got to be careful. You need to think through the details. You need Congress to do its job. And as we'll be discussing, we'll get to this, there's already one piece of legislation that's passed the Senate, which is very worrying with regard to some aspects of these problems. There's other legislation that Amanda's discussing, which is currently being discussed in the House, that could very easily go wrong. And as Corey will emphasize, crypto will be coming to you through multiple channels. You'll be made incredible offers. It'll seem too good to be true, and it probably is too good to be true in those instances. So please, on behalf of all of us, be careful, understand what you're investing in, think about what the politicians are offering to you, ask them what went wrong in the past, and what are you doing to prevent similar problems from occurring in the future. Cryptocurrency is going to be part of our futures, like it or not. But which cryptocurrency? A well-regulated one, a one that doesn't undermine financial stability, and a one that's fair to all people? Or are we going to get a version of cryptocurrency that's destabilizing, that's dangerous, that undermines investor confidence, that maybe undermines the overall functioning of the economy? I would like to say this choice is ours tonight, but it's not, right? The choice is much more in the hands of Congress. But the choice that you have is to become informed, to discuss it, to push your friends and contacts, and to decide who in the political sphere is talking sense and who should be trusted in this regard. So thank you, Ed and Bert, for convening this group. And thank you, everyone, for coming and for listening to my fantastic colleagues for the remainder of this hour. Thank you very much.
Simon, thank you so much also. You really have kind of laid out the framework and I think put out the caveats in the warnings about what we're about to face. And it is really a brave new world out there. So with that, Corey, can you unmute? And I want to introduce Corey Frayer, who is the Director of Investor Protection at the Consumer Federation of America, but also a former advisor to the chair of the Securities and Exchange Commission for crypto markets and financial security. Corey, please.
Thanks so much for having me. And I just want to briefly acknowledge some of my mentors on this call, Simon, Art, Amanda. It's been a pleasure to work with you all so much. And also to acknowledge Brooksley, who I don't know well, but has definitely been an inspiration for me to be able to sort of stand up and talk about these things. I do want to start, and I agree with Simon, this is going to be a part of our future. And it's really important to relate this back to the 2008 crisis. I think sort of the starting point I would take from this is I think there's something relatable about sort of the initial part of this idea. And there's something you can do in Bitcoin other than just send numbers. You can send these text messages. And so the very first thing that the Bitcoin network ever sent was just a simple headline that said, "The Times, 3rd of January 2009. chancellor on brink of second bailout for banks. So crypto originally, long ago, came from this sort of righteous and justifiable anger about our failure, the regulators' failure to prevent a financial crisis, about Wall Street banks and shadow banks, and about this bailout that large banks got while the rest of us were left to fend for ourselves. And so the original idea, which has been perverted, and we'll get there, but the original idea was you could create a better financial system based on two ideas. One is eliminate trust, make sure you didn't have to trust anybody to make your financial transactions, and two, make them transparent so everyone could see what was going on. And so what initially they tried to do was create a community governed system where everyone had to agree on the transactions that happened and not rely on a bank or a broker dealer to execute those transactions for you. They made this ledger that everyone in the public can see the transactions that are happening. And they very intentionally made this system outside the reach of regulators and banks to make sure that what they saw as the failures of that system didn't come into their new financial system. And so those ideas of not having trust and those ideas of transparency, you've heard in a lot of buzzwords like distributed ledger and blockchain and immutability and censorship resistance. All of those buzzwords talk about this very simple idea of doing transactions, digital transactions, without relying on a bank or some kind of central intermediary. And so a lot of people get really focused on the technological process that makes this happen. And it's because it is a truly interesting piece of technology. Um, but it comes with a whole lot of downsides that don't get talked about. And so, because I think it's important not to focus on the technology, but I know there's no way to satisfy people and avoid it. So I'm going to just do a brief rundown on sort of understanding how these networks work to verify transactions, allow these transactions to happen without relying on a central power in the middle. And so, imagine, if you will, that you're sort of in like one of those movies where a kid is trying to hack somebody's laptop. And so they bring out this little device, and that device starts running through every single number and every single letter in the alphabet until it can get into that computer and guess that password. What the Bitcoin network is doing all the time is a big set of guess and check math problems that are really, really hard to solve, and they take a lot of energy to solve. But once you have solved them, you can send them to other people, and they can immediately verify that you solved them. So if you found that password, your friend doesn't have to do the work. You give them that password, they log in, they know you actually got the right answer. And so if you sort of abstract that out and you say, okay, well, I'm going to race you to get to the fastest, to get to the password the fastest. Well, we know that whoever has the faster computer is going to get to that password the fastest. And so what the Bitcoin network does is it takes the person who comes up with this answer the fastest, it broadcasts that out to all the participants on the Bitcoin network, and they verify that it's accurate real quick. And when that verification happens, all those transactions happen on the blockchain. Now, the reason that this is a challenge is because if you didn't have this kind of mechanism, you could spend your money in two places at the same time, right? So it's like check kiting, but for digital assets. And so they came up with this very convoluted and inefficient process. And that process exists to serve exactly one goal, which is to allow this unique case of transferring digital assets from one person to another without anyone in the middle. So when you try to take that into the regular financial system, what you have is it is competing with very, very efficient centralized actors that we normally rely on. And so this inefficiency that makes it work as what it was intended for makes it really challenging to use in the regular financial system. And so crypto has had to try to find ways to get out of the box that it originally created for itself and become more useful and more competitive. And the way they decided to do that is to get political power and change the rules so they don't have to follow the same regulations as everyone else. So again, this was created as this idea for these, they call it decentralized. And that just means we can transact with each other without having anyone in the middle. The other analogy I would make is bearer bonds, right? Which are securities that are issued. They're nameless. You can trade them physically between people. They're supposed to be registered. You're supposed to pay taxes. Famously, they often were not. But essentially, crypto assets are digital bearer bonds. And so, in order to make this arrangement work and profitable, the crypto market started centralizing itself. And instead of having these one-on-one transactions, they started to build these enormous platforms that mix all of the functions of the regular banking system that typically we don't allow to happen in the same place because there are so many conflicts of interest. And so if you take FTX as an example, which is the Sam Bankman-Fried crypto exchange that failed in 2022, very famously, what they had was they were running a crypto exchange. They were custodying crypto assets, which an exchange would never do. They were acting as the broker-dealer, which an exchange can't do. They were the clearing agency for that exchange, which we would never allow. And they also had a proprietary fund that traded on their exchange. And that creates an enormous set of incentives for malfeasance. And what happened in FTX is exactly what we warn about. And it's the reason we separate these functions in the financial system, in the rest of the financial system. They gave their own fund different rules to play by on the exchange. And essentially, they made some bad bets. And because they played by different rules, and because they had crypto assets of their customers, and because they had all these different functions running in the same place, when that fund went down, it took everyone else with it. And so crypto has morphed from this idea to look like something completely different than the banking system and to get rid of those intermediaries to a more concentrated, more dangerous, more conflict of interest prone industry than the Wall Street banks could have ever dreamed of. And so the important thing to think about when it comes to crypto is that it is just a technology that follows on many other technological innovations that have happened in the securities markets and other financial markets for years. So I like to think about when the stock exchanges originally started, you had kids with wheelbarrows full of stock certificates moving that paper between exchanges and clearinghouses to make those transactions happen. Now we have fully digitized the stock markets. If you think about commodities futures markets, you used to have people yelling in pits at each other about frozen orange juice concentrate. Those pits are mostly gone now, and we've for the most part digitized that market. And if you think about checks, checks for your checking account, those used to be paper that was flown across the country in planes and delivered physically to banks. And now what we can do is you tap your phone on a little box, and that box sends a message to a bank, and it says, put this digital entry on your digital ledger. And that's how we deal with cash now. So crypto is just this sort of like slightly different version of how you settle that kind of transaction. But it wants to be treated as a completely different asset class under a different set of rules because the inefficiency that is baked into it is not competitive with the rest of the marketplace. And so what has grown up is this very dangerous, very leveraged, very opaque, very centrally controlled market that is now starting to get its tendrils into our securities and banking markets. And so right now we have this non-compliant $3.7 trillion industry That is a small portion of our $120 trillion securities industry and our $25 trillion banking industry. And the Congress is starting to create loopholes for that small corner of the market that will ultimately allow the rest of the markets to sneak into those loopholes. And when that happens, when the same kinds of economic transactions we have today get treated differently because they claim to be crypto and they claim to be something else, that leverage, those conflicts of interest, all of those rules that we apply to banks and securities markets that don't exist in crypto, all of a sudden we'll be exposed to all of that in our traditional banking system. We have already had to bail out a stablecoin. And Art will talk about stablecoins in a moment and be more precise about that. But in 2023, Silicon Valley Bank failed. We bailed out Silicon Valley Bank, and $3.3 billion of their uninsured deposits were the reserves, the supposed safety net of a thing called US dollar coin, which is the sort of biggest United States-based stablecoin. And so even with, at that time, tough regulators and strong separation between crypto markets and our traditional markets, a failure in the crypto industry, we had to bail out already. So just imagine once you take all of that industry and you put it into our current banking system, and you also lower the regulations for everyone who works in that industry, the legislation we're talking about is exactly the kind of legislation that made it impossible for Brooksley to use the powers of the CFTC to do its job, to get ahead of this kind of problem. And now we're going to do that to the SEC. We're going to do that to the banking regulators, and it is going to end in the exact same result.
Um, well, you got my attention, Corey. As one who has spent a career in consumer protection, uh, I fathom exactly what you're talking about and the problem with conflict of interest. So thank you. Art, I'm going to pass this on now to you to talk about stablecoins, if you don't mind. Art is a professor emeritus of banking law at George Washington University and probably the great experts in the field. So Art, please.
Well,
Feels
thank you very much, Ed, and thank you, Roger, and thank you, Bert Four, who played a crucial role in organizing this, and thank you also for the opportunity to appear on such a distinguished panel. Um, I can only echo what Simon and Corey have already said. Simon laid it out very well. The two major bills that are being considered right now, the Genius Act, which I'll talk about, and the so-called Clarity Act, talk about Orwellian titles that Amanda will talk about. These bills will fundamentally change the nature of our financial system and our financial markets. As Simon said, the Genius Act deals really with the issue about what is a deposit, which really means what is money, and who gets to issue money in our system. And the Clarity Act really deals with what are permitted investments for the American public to buy. And Amanda will deal with that. So let's go to the Genius Act and talk about stablecoins. So what are stablecoins? Cryptocurrencies really fall into two general categories. The first are the ones that you've heard more about, Bitcoin, Ethereum, and so on, Solana. These are what I call fluctuating value cryptocurrencies. They don't have any fixed value. Their price varies wildly. They've had repeated boom and bust episodes. So they are understood up until now to be wildly speculative assets, if you call them that, that really amount to gambling, in my opinion. Well, at first, the industry tried to use Bitcoin as a currency, but that proved to be unworkable for many reasons. But the price variability was one of the biggest reasons. They responded then by inventing something called stablecoins. So stablecoins are digital assets whose issuers represent that they will maintain a stable value connected or pegged to a particular asset. And the most likely asset is a fiat currency, and the most likely fiat currency is the US dollar. So about 98% of today's stable coins are linked to the US dollar. All of the biggest ones are. The two biggest are an offshore stable coin called Tether, with about almost 160 billion out there. And the next one, which Corey mentioned, is the largest U.S. issuer, Circle, with about 62 billion. So they promise that they will maintain reserves that will maintain a stable value with the U.S. dollar. But that in some ways resembles a money market fund, right? That's what government money market funds do. Well, there's a problem with that. Uh, Unless you essentially maintain all of your reserves, perhaps in 7-day treasuries, those reserves are going to be variable in value based upon interest rate movements. And if you maintain any reserves in things like bank deposits, which Corey mentioned, certainly many stablecoin issuers do that, banks can fail. So your reserves are not risk-free. And what happens when some of your reserves decline in value or their obligors default? Then you break the buck and there's a run on you because people don't want a 97-cent or 96-cent stable coin. They want a $1 stable coin. We've had runs on on money market funds twice in 2008 and again in 2020. When money market funds first came along in the 1970s, everyone promised, oh, these will never fail. They're perfectly safe. The government will never need to bail them out. And therefore, we don't need uh, a deposit insurance. We don't need traditional bank regulation. Well, as I say, we've already bailed out money market funds twice. And, uh, and money market funds are regulated much better, much more strongly than stablecoins will be regulated under this miserable excuse for legislation called the Genius Act. Um, so we can absolutely predict that stablecoins will break the buck. There will be runs, and there's no mechanism in the Genius Act to deal with that situation. The Genius Act provides for very weak capital requirements, very weak liquidity requirements. There's no deposit insurance. There's no government guarantee. In fact, the bill specifically says these are not insured deposits. These are not guaranteed by the government. Um, and the only response the bill has is to throw these things into bankruptcy. Well, we've seen what bankruptcy does. The Lehman Brothers bankruptcy took 7 years to resolve at enormous costs. The bankruptcy of FTX, which was considered a model by the bankruptcy court, took 2 years to resolve, again with enormous losses. So who is going to wait 2 years for their money? Okay, so you should understand that the stable coins that the Genius Act intends to authorize effectively will be money. People will believe because they have been authorized by the federal government that they have the same uh, good as gold quality, you might say, as insured bank deposits, because why else would the government authorize them? The ordinary person will not understand the differences, just like they didn't understand the differences with money market funds. Um, we know that any short-term financial claim uh, that's value is variable will eventually have runs. That's why we established federal deposit insurance in the first place, because we had massive bank runs all through the Great Depression and long before that, where there was no deposit insurance. That's why we have the Federal Reserve as lender of last resort. The Federal Reserve is not going to be the lender of last resort for stable coins unless they do something that the statute doesn't permit. Uh, Unfortunately, when emergencies arise, that's precisely what we've seen. The Fed and the Treasury had no duty, and really, in my view, no real authority to bail out money market funds, but they did it anyway because they were trying to save the economy and the financial system from a complete meltdown. So We know that will happen with stablecoins. So we are now essentially undermining the integrity of our money supply. We are taking away control of the money supply even further from the Fed. The Fed will have no meaningful control over stablecoins. The Genius Act permits states like Wyoming to authorize virtually unlimited issuances of stablecoins by very weakly regulated state institutions with virtually no supervision by the Fed. So this will set up a series of runs comparable to those that we saw during the Great Depression. In my opinion, if the stablecoin market grows as big as I think it will. The second thing is that we are now allowing commercial enterprises, including big tech enterprises, to acquire stablecoin issuers. This will be the way in which big tech enters banking. So big tech will now have access not just to your economic consumption, medical information. They'll have access to all your financial information if you choose to put your money in stable coins that they issue. Imagine what big tech could do with all that financial data. They would have surveillance power, cross-marketing power, exclusionary power, unparalleled. We've seen this in China. So you had Ant Group, also called Alipay, and Tencent WeChat Pay. These two giant big tech enterprises in China started with mobile payments and expanded into all other forms of consumer finance and wealth management. And they basically took over the entire consumer Chinese financial system until the government began to crack down on them. They engaged in all sorts of exclusionary practices. If you were a Tencent customer, you couldn't use Ant or Alipay. If you were an Alipay customer, you couldn't use Tencent. And they tried to keep you out of the other competitors like Baidu. So imagine the exclusionary power, the monopoly power that big tech firms would exercise if they got hold of your money. And we already know that. I mean, haven't you had the experience where Google tries to prevent you from using anything produced by Microsoft or Apple and vice versa? Your machine is constantly being compromised by this conflict between the big tech providers. This will happen in finance. And as Corey said, you'll have a whole set of conflicts of interest. Do you think big tech owned stablecoin issuers will do anything to help their competitors? And won't they be used as bailout devices for their own troubled affiliates? That's what we've seen over and over. Now, maybe the worst thing is that so we'll have all these uninsured stablecoins, which essentially will depend upon government bailouts. And they will be allowed, stablecoin issuers have been given so-called incidental powers under the Genius Act that will certainly allow them to offer derivatives, other investment products that are highly risky. The bank regulators allowed banks to get into derivatives through the incidental powers clause of the National Bank Act and a similar clause in the Bank Holding Company Act. And then Congress essentially, as Simon pointed out, endorsed and codified that authority in the Commodity Futures Modernization Act. And banks, use these derivatives to create all sorts of synthetic structures on top of subprime mortgages. So you had under-collateralized and overvalued houses on which not only the mortgage rested, but collateralized debt obligations, synthetic collateralized debt obligations, credit default swaps. You had multiple piles of debts on top of overvalued and under-collateralized mortgages. The situation with crypto is even worse. Amanda, I hope, will give more details on this. But Bitcoin and Ethereum, Solana, XRP, take your pick, they have no inherent asset value. They have no cash flow other than through trading and fees. They don't have anything. It's purely thin air. So now we will have crypto derivatives provided by stablecoin issuers and their affiliates piled on top of crypto assets that have no inherent value. This will be far worse, in my opinion, than the subprime. So I'm calling it subprime 2.0. So the Genius Act and the Clarity Act, if they're enacted, and I pray that they won't be, subprime 2.0 will be coming to a neighborhood close to you, whether you participate or not. I know the word existential threat is way overused, but these bills are an existential threat to our financial system, our economy, our social welfare. I cannot emphasize enough how much we must take every possible measure to defeat these bills. They aren't yet law, and really shout from the rooftops. If you thought subprime 1.0 was bad, I believe subprime 2.0 will be far worse. If I have one or two more minutes, I would just add the following. Crypto has told you that the blockchain and the stablecoins will, modernize payments and will bring financial inclusion. So why is that not true at all? So Corey described the way in which public blockchains like Bitcoin work. And basically it is that sort of everybody has to verify transactions. Essentially, everybody on the network has to verify them in some way, which is a very inefficient and clunky process. And even worse, it's impossible, virtually impossible, to undo a transaction once it's recorded. So there was recently the largest hack in crypto's history, $1.5 billion involving Bitfinex, I think, or Bybit, I'm sorry, Bybit. And Bybit, it was on the Ethereum blockchain, and Bybit explored the possibility of undoing that transaction through a so-called hard fork. And their members revolted and said, no, you cannot undo a transaction that's been recorded on a public blockchain. That's contradictory to the whole idea. So if you can't undo a transaction, that means you can't correct a wrong payment. You can't correct a fraudulent payment. You can't do any of the things that you would do if you use a credit card or a debit card and it turns out that the transaction was fraudulent or in some way defective. You can't undo it. So public blockchains offer nothing because they're very slow and inefficient, and you can't undo mistakes or fraud. In contrast, as Corey pointed out, we're already digitizing banking through permissioned digital ledgers that are either controlled by a single bank or they're shared among several banks. Those banks can verify the transactions. They can undo mistaken or fraudulent transactions. Most importantly, somebody is accountable. You see, with public blockchains, as Corey pointed out to you, they essentially are anarchic delusions. Everybody's responsible, nobody's responsible, which means nobody can be held accountable when things go wrong, even when nefarious people have done some nefarious things. That's part of the crypto screed, right? The crypto creed. You can't hold us responsible because everybody was involved. Well, we know that wasn't true, e.g., Sam Bankman-Fried and FTX. But this is why this whole idea of operating on public blockchains for financial transactions is crazy. We need to hold people accountable. In fact, we have to have trust in our financial system. We have to have trust in our intermediaries. That can only be done, excuse me, that can only be done through accountability, transparency, and proper legal regulation. So I will now turn it over to Amanda, but please take every action you can to stop these bills from being passed.
All right,
Thank
thank you. And just to reiterate, the Genius Act has already passed one house, and it's on the verge of passing the other house.
Yes, the Senate has passed it, and so if the House agrees to pass it in its current form, it will go to the president. Fortunately, there's been some difficulty in their reaching that point in the House. Hard for me to know how how much of a roadblock it is. Maybe Amanda can tell us more about that. But um, there is still there's still time. I hate to go back to On the Beach, but the final scene of On the Beach, there is still time, brother. There is still time, brother and sister, to stop this bill, perhaps. I hope.
Without getting too deeply into the politics, unlike a lot of what many of us object to, this is bipartisan. This is not one party cramming it through the other
Yes, and
with one or
unfortunately,
two votes.
there's a very simple and unfortunate explanation. The crypto world poured more than $250 million into the last election round. Um, they accounted for half of all crypto PAC contributions in 2024. They elected 53 of 58 congressional members they backed. They defeated some very prominent crypto skeptics like Sherrod Brown and Katie Porter. They got rid of them. And I think, unfortunately, the Democratic members they helped to elect, and even those they didn't help to elect, have been cowed by the tsunami of money coming into Congress. And I think that the industry has made this calculation. Hey, if we can buy Congress and the presidency, because President Trump was totally against crypto until they started backing him with another 100+ billion of dollars. Until, if we can buy the president and Congress with 250 or $300 billion, I'm sorry, million, I should say, not million. If we can buy them with 250 or $300 million and make potentially billions of profits, that's a good test. That's a good trade-off for us. I think it's sad. I agree with you, Ed, that there's no other explanation for why uh, progressive or sensible members of Congress would be adopting uh, these bills, particularly after what we saw in 2022, when there was so much crashing and burning of all these prominent crypto companies during the last crypto winter.
And you mentioned Trump's skepticism, and we haven't
Yes,
mentioned, and I'm not about to mention, but I will, his personal investment.
yes, he's jumped aboard the bandwagon. They've obviously made that very attractive to him.
Yeah. By the way, you don't buy Congress, you only rent them. Um,
Yes, that's fair.
Amanda, I guess we'll turn to you. You're currently the policy director and COO of Better Markets, and particularly relevant to this discussion, you're the former chief of staff to the chair of the SEC. So I'll pass this on to you now, please.
Well, thank you so much for inviting me here. And thanks really to the folks that showed up to learn about crypto on a Wednesday evening. It really makes me heartened that so many people are interested. I'm going to use this time to talk to you about what's known as the Clarity Act. And as was mentioned, this is being debated currently on the House floor. And it does have some decent prospects of being enacted into law if they can peel away enough Democratic senators. And that's really an open question right now. So I would encourage you all to engage on this bill because it really is open for debate right now. So when I talk about the Clarity Act and crypto market structure, what I mean is the rules around how investments trade on exchanges, how brokers and investment advisors can sell those investments to ordinary retail people, and the regulatory framework that surrounds it. So as folks likely know, we had the stock market crash of 1929 and the Great Depression. And coming out of that, the Congress passed the Securities Act of 1933 and the Exchange Act of 1934, seeing how unregulated investments, frenzied speculation, borrowing on margin to make leveraged bets in speculative markets, we saw how that could all come crashing down. So Congress, in those two foundational FDR New Deal laws, created a framework around fair and full disclosure for investments when they're sold to the public, rules around brokers and their obligations to customers when they promote and sell those investments. And then rules around exchanges so that when these investments are bought and sold on the secondary market, there's price transparency, there's tracking of activities so that you can police for insider trading and other manipulative behavior, and also like a foundational separation of functions between the companies issuing the stock, the brokers, and the exchanges to ensure that conflicts of interest weren't distorting market prices and defrauding investors. So over time, I mean, as it happens in our economy, companies go to the market to raise money from investors. They take that money from investors. They promise them that, if certain conditions or metrics are made, they can get a good return based on the prowess and the expertise of the managerial team of the company. And Congress passed these laws in 1933. A lot has changed in technology over time. And we have seen a raft of court cases develop over 90 years, really defining the borders and boundaries of what is an investment that's regulated by the SEC. And there was a seminal case in 1946, which defined what an investment contract was regulated by the SEC. And it basically says, is there an investment of money in a common enterprise where you can have a reasonable expectation of profit based on the managerial efforts of others? In other words, are you giving money to somebody that promises that they're really smart and they're going to make you some money? And if that's the case, you're regulated at the SEC. And the rules aren't that onerous. You just have to disclose what you're doing with the money. You can't lie about your background. You need to get audits. And then when you go to sell those investments on, they have to trade on regulated exchanges so we can have confidence in the price of it moving forward. So 1946, the law is able to accommodate all sorts of novel investments, not just stocks and bonds, but people have registered fractionalized racehorses with the SEC, fractions of Picasso paintings, eel farms, whiskey caskets, you name it, real estate construction deals. All of these are registered securities. But crypto comes along. And as Corey pointed out, it started as this peer-to-peer kind of alternative, almost punk promise that eschewed regular markets, but people realized it was a money-making opportunity, so the intermediaries sprung up. So all these entrepreneurs started saying, give me your money. I'm going to make the best blockchain project you can imagine. And in fact, a lot of companies just started slapping the word blockchain to the end of their name to get more money. And it's the first Trump administration, and this is all starting to proliferate. So to their credit, the first Trump administration starts getting all these investor complaints about getting defrauded in crypto markets. And at the time, they couldn't really ignore it. So they started bringing cases against these crypto issuers, these companies that are raising money from the public for their crypto. And the SEC is successful. They sue and basically say, you meet this 1946 definition of a security. And the Trump SEC litigated or settled 75 cases on crypto companies. The judges across the country deciding that these are unregulated securities. But what the Trump administration didn't do, they went after the fly-by-night street-level criminals. But all of these platforms started springing up that facilitated investors buying these crypto scams. Think Coinbase, Binance, Kraken. And what the first Trump administration didn't do is go after the big fish, the distributors. So when Gary Gensler came to the SEC, he said, look, whack-a-mole against every fly-by-night crypto company that comes up, we're never going to protect people because people create crypto out of thin air. We need to get these platforms registered. They need to look like the New York Stock Exchange or the NASDAQ. And the companies refused to do so. They were not interested in it. And it's basically because they had developed this business model that was vertically integrated, that allowed them to be the broker, the exchange, the clearing agency, and even have venture capital arms where they were investing in crypto projects and then giving those crypto projects preferential access to their exchange. So imagine if you're the New York Stock Exchange and you have a venture capital arm that invests in a biotech company. You decide, I'm going to let that biotech company list on my exchange and not their competitor. What does that do to the market? It distorts markets and it doesn't allow for fair competition because the affiliated company is going to get access to a bunch of investors and retail eyeballs. But this is what crypto does. They also have hedge funds, as Corey mentioned, that trade on their own exchange. And in fact, a lot of times have been accused of faking volume on the exchange to make it look like there's more interest in a crypto project than there really is. So back to the Biden administration, this all culminates. They don't want to register. Litigation begins to get them to register. The crypto companies hire the most expensive attorneys across the country to fight it. And in jurisdiction after jurisdiction, the SEC continues to win. Then the election happens and President Trump is inaugurated. We see all of these ongoing litigations in an unprecedented form start getting dropped. The administration unilaterally decides they no longer want to prosecute these cases. So that's where we're at right now. And against this backdrop, the industry has decided that they want to retroactively change the law, providing themselves with amnesty for all past misconduct. And that's not just amnesty from the SEC, it's amnesty from private litigation of defrauded investors and state law enforcement action. So the Clarity Act would provide retroactive amnesty. It would legalize their business model, allowing all of these functions to commingle. So again, you go to Schwab today and you buy a share of Apple stock, they're supposed to find you the best price in the market. You go to Coinbase, they sell you Bitcoin for whatever it's trading on their exchange, and there's no obligation to get you the best price. You go to an investment advisor today, and they have a fiduciary duty to you to provide you with investment options that are best suited to your risk tolerance and your savings needs. They can't sell you products that give them a higher fee. Not true in the crypto world. No fiduciary duty, no concept of investment advisors. This idea of like trade surveillance and insider trading does not exist in the Clarity Act, is not imported over from the securities laws. Cyber breach notifications not protected. The legal recourse to sue for fraud not as strong as under the securities laws. And then also right now you pay brokers pay into an insurance fund such that if they go bust due to a hack or a failure, you can get up to $250,000 and other remuneration back. No insurance for crypto brokers. So the bill ensconces all of that and basically takes this concept of an investment contract or an investment of money in a common enterprise with an expectation of profit and tells companies you can raise money in an easy pass version that basically is a very light touch version of SEC regulation. And once you self-certify that your cryptocurrency has matured, you get out from under any of the trading rules that currently apply at the SEC, and you get to move over to the agricultural derivatives regulator, the CFTC, which has a role in the market but is not designed for these retail investments like we see in crypto. So, the bill is really bad on its face. It's a way that is deliberately designed by the sponsors to try to get the camel's nose under the tent of the New Deal. Like it is a very deliberate attempt to dismantle 90 years of protections that the industry has argued make it too hard for businesses to raise money. I think all of us, all the presenters today would argue the contrary, that it's those strong protections that have made the US the financial center of the world because people trust our markets. But the industry has long tried to get out from under it, and this is a really clever way to do so, and not just crypto will benefit. We already see Robinhood, the broker, offering 200 different stocks on a blockchain, a tokenized version to European investors. So it's basically a synthetic instrument that purports to track the Microsoft share price or the Nvidia share price, but with none of the protections. And they claim that it's firewalled to US users. I don't really trust the VPNs, but it's a way to create a light touch regime that's much cheaper for Robinhood to operate and give investors the illusion that they have exposure to these companies with none of the voting rights, none of the shareholder uh, requirements of a public company. And we already see huge distortions where the prices of Microsoft in this tokenized version are very untethered from the stock version of the US, which I think long term is going to create a lot of problems for companies looking to raise money and the orderly functioning of markets. So that's the market structure legislation. I appreciate you all listening. It will metastasize outside of crypto if permitted to do so, and I really worry about the integrity of our entire like stock exchange, broker, retirement savings system.
Amanda, thank you. And we're at the top of the hour, but I did want to ask a question, a couple, well, I've got a ton of questions, as does everybody here. We don't really have the time for it, but I did want to, I mentioned at the beginning that there was a third bill that is being considered that relates to the central bank, prohibiting the central bank from having a digital currency. Could you just, so one of the three or four of you, just explain briefly the significance of that and why they feel so strongly about it? I
I'll
don't
take
know.
a shot at it, and I think Simon might want to add a word too, perhaps. A central bank digital currency essentially would be uh, for the central bank essentially to become the exclusive issuer of money. If we're talking about the most thoroughgoing proposals, a so-called retail CBDC. So the banks would no longer uh, issue deposits. Essentially, the central bank would issue all money and hold all deposits, except to the extent that they subcontracted part of that function to banks. But you would not hold a deposit in Chase, JP Morgan Chase or Bank of America. You would hold a deposit in the Federal Reserve. Um, Now, the reason I think that is so strongly opposed by the Freedom Caucus and what I would call libertarian folks is that potentially a central bank digital currency issued directly to you by the central bank would give the central bank a number of really pretty awesome powers. One is presumably they would have to decide what to do with cash. And in some countries, they have abolished cash in favor of the central bank digital currency because cash can be used in an underground economy. Uh, Central bank digital currencies can be traced. And so this would allow central banks to trace who has money and how it's spent, who it goes to, and essentially to track your spending patterns. And of course, the potential surveillance aspects of central bank digital currencies has created much opposition among, as I say, libertarian-minded folks. The other main opposition, and not surprisingly, comes from traditional banks who realize that they would be again really relegated to the role of subcontractors if a true full retail CBDC was issued. And there is another problem which worries me a bit, which is if the Fed, issues and takes all deposits and subcontracts to banks, the Fed would, I think, even much more than they do, have to oversee how that money is lent out, who it goes to. And I think it would involve the Fed in more difficult credit allocation decisions than it currently has. As you might suspect, I'm skeptical of CBDCs. I realize there are many points that have been made in favor of them, which is that it would provide universal access to financial services. And I think banks, I keep telling my banking friends, if you want to stop a CBDC, start providing universal access to bank accounts with payment services at reasonable prices with reasonable charges so people can actually use them. The more you exclude people, the more you invite the Fed to step in with a retail CBDC. But I'd be interested in Simon's take if you'd like to add a note on that.
I don't disagree with the point you're making out. I think there are other versions of CBDCs that could be more moderate or mild and not try and take over all banking activities. It certainly could help with financial access. But I don't, the main point is I don't think it's going to happen. I think for the reasons we've talked about today, the crypto industry is very powerful. They have a narrative, which I think the three of you have really summed up beautifully. And they have a lot of political power, which comes from the money that they've spent. So they'll make sure that the Fed can't get in the way. They'll shape the markets in the way that they want. They will create these quote unquote stable coins. And as I think one of you already said, these are Orwellian names. All these names are Orwellian, meaning the exact impact of them will be the opposite. It will not be a stable coin. It will not be. There will not be clarity. It isn't a genius act. There's no genius here at all. It's money, and it's money that has bought privilege and access. And as Amanda said, the bigger picture here is an attempt to undermine the securities markets, which have served us well since they were resurrected after the disaster of the 1930s. So here we go again.
Well, Simon and Corey, Art, and Amanda, thank you. Fairly sobering message you were delivering. And I'm an action-oriented kind of person, and I'm trying to think, okay, now what? And it sounds like the only thing at this particular point in time is to get on the phone tomorrow and call your favorite member of the House of Representatives and say, look, we got to take a step back and think about what we're doing. It's not ready for prime time. And I think it's an uphill battle, but as far as I can figure, it's about the only thing available to us on this particular day at this particular time. And so I would encourage you to do that. We will be putting a video or the recording of this session up on our website. I put our website on the chat. It's Partners for with the digit 4 democracy, not Partners for partnersfordemocracy.com. And it will be up in about 24 hours. And if you want to take a look at what else is on our website and learn more about our organization, you're welcome to do that. If you're interested in signing up, there's a place to do that. So I thank you. I particularly thank our 4 speakers who did an extraordinary job of, I said it was the impossible, which was to explain and put in English in 1 hour what this is about. And I think you've given us a pretty good flavor. And I'm very grateful to the 4 of you for participating tonight, and particularly grateful to the 4 of you for your advocacy in this area and your insights and sharing them. So thank you, and everybody have a good evening. Bye-bye.